Most people assume money already exists before banks lend it. In reality, much of the money in modern economies is created when banks issue loans. When a bank approves a mortgage or a business loan, it does not transfer pre-existing cash from another account. Instead, it creates a new deposit in the borrower's account. That deposit becomes spendable money in the economy. This process expands the money supply without printing physical currency. It is a core mechanism of modern financial systems. During economic expansions, lending increases and money creation accelerates. During downturns, lending slows and the money supply can stagnate. Understanding how banks create money is essential to understanding credit cycles, asset prices, and financial stability. In modern economies, most money exists in digital form as bank deposits. These deposits are liabilities of commercial banks and assets for households and businesses. Central banks issue physical currency and reserves, but the majority of money circulating in the economy originates from commercial bank lending. When a bank grants a loan, it records two entries on its balance sheet. The loan becomes an asset for the bank, and the borrower receives a deposit, which becomes a liability for the bank. This accounting process expands the supply of money within the banking system. Banks cannot create unlimited money. They must meet capital requirements, maintain liquidity, and manage risk. They also rely on central bank reserves to settle payments between institutions. However, within these constraints, lending activity directly influences the amount of money circulating in the economy. Credit-based money creation allows economies to grow faster than they could with fixed supplies of physical currency. By extending loans, banks enable households to purchase homes, companies to invest in expansion, and governments to finance infrastructure. The promise is flexibility. Money supply can expand in response to economic demand rather than remaining fixed. This structure also distributes credit decisions across thousands of institutions rather than concentrating them within a central authority. Central banks influence the process indirectly through interest rates and regulatory policy. Lower rates encourage borrowing. Higher rates restrain lending. Under stable conditions, the system appears balanced. Credit expands alongside economic growth. The promise of credit-based money is dynamism, an economy capable of financing new activity without waiting for existing savings to accumulate. Credit creation expanded dramatically during the 20th century as banking systems modernized and financial markets deepened. Mortgage lending transformed housing markets. Corporate credit fueled industrial expansion. Consumer lending supported household spending. Globalization amplified these dynamics. Capital flows crossed borders, and banking systems integrated into global networks. Financial innovation introduced securitization, derivatives, and structured lending products. These instruments redistributed credit risk and expanded the capacity of the system to generate loans. Central banks supported growth through monetary policy, adjusting interest rates to manage inflation and economic cycles. Over time, credit creation became a central driver of asset prices. Real estate markets, equity valuations, and corporate expansion increasingly depended on borrowing conditions. The rise of credit-based money did not occur through a single reform. It evolved gradually as banking systems expanded and financial infrastructure developed. Credit-based money creation contains an inherent cycle. When economic conditions are favorable, banks extend more loans. Rising asset prices reinforce confidence. Borrowers appear solvent. Lending standards loosen. This expansion increases the money supply and fuels further investment and consumption. However, the process can reverse quickly. If asset prices decline or economic conditions weaken, borrowers may struggle to repay debts. Banks become cautious. Lending slows. Because loan repayments destroy money created during the lending process, contraction in credit can reduce money circulating in the economy. The system does not collapse instantly. It slows through tightening credit conditions. Businesses postpone investment. Consumers reduce spending. Financial crises often emerge when excessive credit expansion meets declining asset values. Defaults rise. Banks write down losses. Lending contracts sharply. Central banks attempt to stabilize the cycle through interest rate adjustments, liquidity provision, and asset purchases. The vulnerability lies not in money creation itself, but in the feedback loop between credit expansion and asset prices. When credit grows too rapidly, financial stability can weaken. When credit contracts abruptly, economic activity can decline. The system depends on maintaining balance between expansion and restraint. A severe contraction in credit creation can trigger recession or financial crisis. Lending standards tighten. Borrowers lose access to refinancing. Asset prices fall as demand weakens. Banks attempt to preserve capital by reducing risk exposure. New loans become scarce. Central banks often intervene by lowering interest rates, providing liquidity to banks, or purchasing financial assets to restore confidence. The collapse of credit expansion is rarely permanent. Lending eventually resumes once balance sheets stabilize and economic expectations improve. However, the adjustment period can be painful for households, businesses, and financial institutions alike. After credit cycles reverse, regulators often introduce new safeguards. Capital requirements may increase. Lending standards tighten. Banks reassess risk models and balance sheet strategies. Yet the underlying mechanism remains unchanged. Credit creation continues to drive economic expansion. Financial systems depend on lending to sustain growth. The challenge is preventing excess without stifling activity. Money creation in modern economies is not a static supply managed solely by central banks. It is a dynamic process driven largely by commercial lending. Banks expand the money supply when they extend credit and contract it when loans are repaid or written off. This mechanism fuels economic growth, but also amplifies financial cycles. Understanding money creation reveals how deeply credit conditions shape the economy. In modern finance, money is not only a store of value, it is also a record of debt.